Robinhood, not the Archer, but the app, has recently filed fairly secretly actually for a IPO with the SEC. They submitted something called an S1 filing, which is a registration with the Securities and Exchange Commission in the US that they can make without actually disclosing any financial information. Now, Robinhood, of course, is a commission-free trading app over in the United States. It's not available here in New Zealand, but nonetheless, it has been widely rumored that an IPO might be happening for Robinhood at some point. And there'd been also a fair bit of speculation that Robinhood may actually kick that can down the road and IPO a lot later than they had initially planned due to all of the craziness that has happened with the controversy around the whole GameStop short squeeze and stopping trading on GameStop shares kind of situation that happened back in January. So in this video, I want to look at a potential Robinhood IPO as kind of an analysis of the company as an investor. Now, of course, we haven't got any sort of hard financial data to look at in this video just yet, but I want to sort of talk through Robinhood's business model, what I think their potential future prospects are for growth, and whether it's an investment that I may or may not be considering once the IPO does eventually happen for Robinhood. Now, Robinhood as a business has actually been around for quite a while. It was first started in 2013, and one of the co-founders, Vlad Tenev, is actually still the CEO at Robinhood today. And Robinhood in the past 1 to say 3 years has really exploded with growth. It was the first company that really came out and widely offered zero commission trading for buying stocks. And they also released an app that is, by all accounts, very, very simple. Sometimes even it would be argued that it's overly simple to actually use, so that people can go in and buy shares directly from their smartphone for a zero frictional cost. And Robinhood moving to the zero commission kind of business model actually forced a lot of their competitors to do the same thing. A lot of the big brokerage houses over in the States have now also switched to commission-free trading. And we hear people like Charlie Munger back here at the Daily Journal meeting, for example, recently actually describe commission-free trading as one of the biggest current scams in the stock market. So let's talk through how a brokerage actually makes money if they don't charge for a commission. Typically, when you use a broker of any kind, they collect a fee on a transaction that you make when you buy or sell a particular asset. But if Robinhood is not capturing anything on that transaction, how on earth are they actually making money? Now, Robinhood as a business actually makes money by selling something called order flow. Now, order flow is simply what drives stock prices in the very short term. If you have more buyers than sellers, the price of that particular security tends to go up. And if you have more sellers than buyers, then the price of that security tends to go down. So that is really what drives stock prices in the short term. And basically what Robinhood are doing is they're selling that order flow information to other brokerage houses. And the downside from a customer's perspective of their order flow being sold to a third party is basically that they might not actually receive the best possible price when they're buying or selling shares. If you take a really well-known broker worldwide like Interactive Brokers, for example, which I don't have any affiliation with Interactive Brokers or anything like that, but if you take an example like Interactive Brokers, they charge a commission on any trades that you make through their platform, and they have access to many different stock markets around the world. And when you buy shares through Interactive Brokers and you pay them a fee to do that, basically their primary goal for you as, you know, the paying customer is to try and get you the best possible price for those shares. So if you have shares of a company trading at, say, $100 and there's typically sort of a bid and ask kind of spread in and around that, a price that sellers are willing to sell at and a price that buyers are willing to buy at, which is typically quite a tight spread on most stocks, they try to get you the best possible buy price or the best possible sell price. Now, in the case of Robinhood, who are selling order flow to third parties, that's not necessarily what is going to happen when you try and buy shares. And that was really the core of Charlie Munger's criticism of Robinhood, is that they are sort of marketing themselves as this commission-free trading platform, but the price that you actually get when you buy shares is potentially not anywhere near as attractive if you were to use some other broker where you actually actually pay a commission, but you're probably getting those shares at a cheaper price. That is really how Robinhood makes revenue and makes money, is from selling their order flow to market makers. They do also offer things like margin loans and options trading, which they can make some money on as well. But in terms of just simply buying and selling shares straight up, they don't capture a commission at all, but they do sell that order flow information. So that's sort of the first M in our kind of 4M Phil Town style checklist for going through and analyzing a particular investment, which is meaning, moat, management, margin of safety. That's kind of the meaning and how the business kind of fundamentally operates. So if we move on to moat and start to think about whether Robinhood has any sort of competitive advantage that will allow them to do really well over time versus a bunch of their competitors, this is where, again, I start to struggle to see some of the potential advantages that a company like Robinhood actually has. Now, what really drove Robinhood's initial growth was sort of two main things. So the first thing was that they had zero commission trading, and that was really attractive for people who maybe don't understand the sort of background mechanics of selling order flow and trying to capture the best price when you're buying shares and so on. That was the first main thing that they marketed themselves, marketed really well, and were able to grow the business that way. The second thing is they have, by all accounts, really simple and easy to use app. Compare that to a lot of the traditional brokerage products where you're logging into some website that looks archaic, or even if we go back a little bit further, you're having to get on the phone and call a broker and explain what kind of trade you're wanting to make. There was just a lot less friction, and it was a lot simpler to use for individuals that were wanting to get started in the stock market. And as the name suggests, Robinhood, they were really coming in with the goal of trying to democratize stock investing and trading to everyday people that don't have millions of dollars to invest and don't want to spend time on the phone talking to brokers and trying to figure out how to use these really old and tricky, difficult kind of online systems that many of the traditional brokers at least used to have. And from the perspective of someone who is looking to try and analyze this business as a potential investment, two of those competitive advantages have really driven the growth over the past few years, and I really see some weakness in both of them. So the first one with the zero commission trading, there are a lot of other brokerage platforms in the US that have now taken that on board. You now have a long list of other brokers based in the US who offer commission-free trading, and these are both the traditional brokerage houses as well as some of the newer mobile-based ones. So really, to a large extent, I think that competitive advantage is not something that's going to sustain out into the future. So that is something that I really see as an issue for Robinhood, is trying to grow their business over the long term. The second thing is kind of the easy to use app. Now, again, they do have some advantages here from my perspective and at least my interpretation of how Robinhood works. Again, I haven't been able to use it. It's not in New Zealand. They do probably still have some advantages there, but at the same time, there are many other competitors coming into this landscape. I'm sure you've watched many US finance YouTube videos and you've seen plugs for tools like M1 Finance, for example, and many other brokerage platforms that basically have the same value proposition as Robinhood. They offer a simple, easy to use app, and they have commission-free trading. But nonetheless, they do have a pretty significant head start, and it's really hard for me as someone who's kind of all into this kind of finance world and is interested in this stuff. It's really hard for me to get a feel for what the typical Robinhood user would really be paying attention to. Do they even know that these other platforms exist, and do they even know how order flow impacts the prices that they pay for their shares and that sort of thing? I don't quite know. That's something that I would love to get feedback on if you guys are familiar with that at all. So that's our first two M's in the 4M analysis. The third M is of course management, and again, this one's been kind of controversial. We have Vlad Tenev, who has recently been put in front of Congress after the recent GameStop saga, and again, it's just really difficult to assess whether that is the right person to run the business. And to a large extent, management skill and integrity can actually be kind of detected by how they talk to their investors and also their actual performance in the business. And that is to a large extent something we haven't been able to see. So Robinhood up until this point has been largely funded by private equity money. So, we haven't been able to see communications from the Robinhood management team to those private investors like we would in a public company. We don't get access to the conference calls or investor letters or anything like that. And we really have no feel for whether the current management team is growing the equity of the business through, intelligent management decisions or not. So in this case, management is a bit of a tricky one to assess, other than the interviews and so on that are available with guys like Vlad out there on the internet. There's plenty of those interviews out there now if you want to go and check them out. And of course, the fourth and final part of our 4M analysis is margin of safety, or trying to come up with some sort of intrinsic valuation for a particular company, and then of course trying to buy it for less than it's worth. Now, typically when you look at a company going through an IPO process, there is almost zero chance that you're going to get an obviously good deal at that point. So, IPOs are all about trying to raise as much money as possible with selling as small a percentage of the company as possible. The chances in pretty much any IPO that you're going to get a massive discount to underlying intrinsic value is pretty slim, but nonetheless, companies can come out and, smash it out of the park and beat all expectations and go on to do very well. But we really don't have any of the information required to calculate an intrinsic value for Robinhood just yet. We can't see how much money they're earning or how much money they're losing right now, and we really can't see too much of their growth history up until this point in order to try and get a feel for where we think they might go out into the future. So calculating an intrinsic value is really not possible right now, but it hopefully will be once we have more information presented to us pre-IPO. But there are a couple of figures that are floating around on the internet. Now, the first one is the valuation that was put on the Robinhood business at the last capital raising that they did, or at least a capital raising that they did last year. And that number was $11.7 billion. The other number that we have getting sort of just thrown around at the moment is a potential $40 billion valuation based on some of the analysts, work at investment banks and so on. But really that final number in particular is just pure speculation right now. We're really just going to have to wait and see where this IPO price and valuation sort of turns out once they're further down the track of getting this company public. So there are some initial thoughts from me on a potential Robinhood IPO. I think it's probably going to be one of these companies that, like a lot of businesses I look at, I'm going to be kind of just sitting on the sidelines and watching interestingly, from that point. I'll have my popcorn ready and I'll just be watching what happens. I don't think it's really got the history of growth and, the information available for me to really make a decision on being confident that it's going to do well into the future, nor does it have some crazy good competitive advantage over a bunch of the other brokerage players in the industry. So for me, it's probably going to be a pass almost regardless of what the valuation looks like when we get to that point and how the financials look, just simply because it doesn't check those other boxes of business quality for me personally. But again, I'll be watching with interest from the sidelines, and it's certainly going to be a massive news story once it does come out. So that's it for me today. I do hope you enjoyed the video. If you did, please hit like and hit subscribe, and I will see you in the next one. Cheers.